Welcome back to my channel. Today we will explore the fascinating world of investment from unique perspectives. Today, we delve deep into the human mind and uncover the psychological underpinnings that influence our investment decisions. Why do we sometimes make irrational choices? What drives our fears and motivations in the market? By understanding concepts like loss aversion, the herd mentality, and overconfidence, we can become more mindful. So, let's embark on this enlightening journey into the psychology of investing. Understanding the basics. The human brain is wired to make decisions that ensure our survival. In the context of investing, this can sometimes lead to choices that are not optimal for financial growth. The key systems in the brain play a role here. System 1: fast thinking. This system is quick, intuitive, and emotional. It helps us make snap decisions, like avoiding a speeding car or catching a falling object. System 2: slow thinking. This system is slower, more deliberate, and analytical. It helps us solve complex problems, like planning our finances or analyzing an investment. While System 1 can save our lives in dangerous situations, it can also lead to impulsive and irrational investment decisions. Understanding when to rely on System 2 can help us make more informed choices. Behavioral finance is a field that combines psychology and economics to understand why investors often make irrational decisions. Traditional finance theories assume that people are rational and markets are efficient. However, behavioral finance acknowledges that emotions and cognitive biases often drive our decisions, leading to market inefficiencies. Key psychological concepts in investing. Loss aversion refers to the tendency of people to prefer avoiding losses rather than acquiring equivalent gains. This concept was introduced by psychologists Daniel Kahneman and Amos Tversky. For example, the pain of losing $100 is often more intense than the pleasure of gaining $100. During a market downturn, many investors panic and sell their assets to avoid further losses, even if this means realizing a loss. This behavior was evident during the 2008 financial crisis, where fear-driven selling led to a significant market decline. Investors who held onto their investments or bought more during the downturn generally fared better in the long run, illustrating the importance of overcoming loss aversion. The herd mentality describes how individuals in a group can act collectively, without centralized direction. In investing, this can lead to asset bubbles and crashes. When people see others buying a particular stock, they are likely to follow suit, often without conducting their own analysis. In the late 1990s, the dot-com bubble was driven by herd mentality. Investors poured money into internet-based companies, often without understanding their business models or potential for profitability. As more people invested, stock prices soared. When the bubble burst in 2000, many investors faced significant losses. This event highlights the dangers of following the crowd without conducting independent research. Overconfidence is the tendency to overestimate our own abilities, knowledge, and predictions. In investing, overconfident investors may take excessive risks, trade too frequently, or fail to diversify their portfolios. Day trading is a common example of overconfidence. Many novice traders believe they can consistently outperform the market through short-term trades. However, studies show that most day traders lose money over time. Overconfidence can lead to frequent trading, higher transaction costs, and poor investment returns. Experiments and studies illustrating psychological concepts, the marshmallow test, conducted by psychologist Walter Mischel, is a famous experiment on delayed gratification. Children were given the choice between one marshmallow immediately or two marshmallows. If they waited for 15 minutes, the ability to wait was linked to better life outcomes, including financial success. In investing, delayed gratification is crucial. Those who can resist the temptation to sell during market downturns or chase after hot stocks often achieve better long-term results. This experiment underscores the importance of patience and discipline in investing. The ultimatum game involves two players. One player proposes how to divide a sum of money, and the other can either accept or reject the offer. If rejected, both players receive nothing. The game reveals insights into our sense of fairness and decision-making. In investing, the perception of fairness can influence market behavior. For instance, if investors perceive a company's executive compensation as unfairly high, they may be less likely to invest in that company, affecting its stock price. Understanding how fairness perceptions impact investment decisions can provide valuable insights for investors and companies alike. Strategies to overcome psychological biases. One of the best ways to mitigate the effects of psychological biases is to adopt a long-term investment strategy. By focusing on long-term goals rather than short-term market fluctuations, investors can reduce the impact of loss aversion, herd mentality, and overconfidence. Diversifying your portfolio can help manage risk and reduce the impact of any single investment's poor performance. This strategy counters overconfidence by acknowledging that predicting individual stock performance is challenging, and that spreading investments across different assets can provide more stability. Investors should continuously educate themselves about the market and their own psychological tendencies. Self-awareness is key to recognizing and mitigating biases. Reading books, attending seminars, and seeking advice from financial professionals can help build a more robust investment strategy. Establishing clear investment rules and sticking to them can help counteract emotional decision-making. For example, setting stop-loss orders can prevent panic selling during market downturns, and adhering to a predetermined asset allocation can ensure diversification. Financial advisors can provide objective, third-party perspectives that help mitigate personal biases. They can assist in developing a well-rounded investment strategy and offer guidance during volatile market conditions. Understanding the psychology of investing is crucial for making more informed and rational decisions. By recognizing and addressing biases like loss aversion, herd mentality, and overconfidence, investors can improve their financial outcomes and build more resilient portfolios. Remember, the key to successful investing lies not only in analyzing numbers, but also in understanding the human mind. Stay curious, stay informed, and happy investing. Thank you for joining us today. If you found this video insightful, Don't forget to like, comment, and subscribe for more fascinating content on investing and beyond. Until next time, keep exploring and stay wise.